So let's talk about corporation tax and what exactly you might need to know as someone who has a business here in the UK. Now, to start with, what exactly is corporation tax? Your corporation tax is basically a type of liability that's imposed on the profits of UK limited companies, corporations, and other types of entities that may be run here in the UK. Now, what does this mean to you? Okay, this basically means that if you are a business owner who has a UK limited company, or indeed you might be a foreign business owner, but you have some of your operations run here in the UK, then your company will be subject to corporation tax on its profits, okay? Now let's talk about when exactly your corporation tax payments are due. Corporation tax is usually due 9 months and 1 day after the end of your company's accounting year end, okay? So that means if your accounting year end date falls on March 31st, then your corporation tax needs to be filed, submitted, and sent over to HMRC latest by the 1st of January the following year, okay? So it's very important to bear this in mind if perhaps you are a business owner who has just set up their company and you're unsure of what some of these terms mean and also when your deadlines might be, okay? So the next thing you might be thinking about now is how exactly do the corporation tax payments work? How much exactly do you need to earn as a business before you start paying corporation tax? Because there are different rates and thresholds, and depending on what rate and threshold you fall into will depend on what exactly your percentage of corporation tax is going to be on your profits. So for instance, if you're a company and you actually had a profit figure of about £250,000, you will pay corporation tax at what is called the main rate, and the main rate figure of corporation tax is currently 25%, okay? However, if you're a business owner and you happen to make a profit figure that is anything up to £50,000, then you will be paying your corporation tax at a slightly reduced rate of 19%, which is also known as a small profit rate figure, okay? So this is definitely worth bearing in mind when it comes to budgeting an amount for your tax payments at the end of the year, because if you have an idea or an approximate figure in mind of what your profit is likely to be, then you can budget well in advance for this so that you are not caught off guard. It's also important to bear in mind that these figures are subject to change and could change within any particular tax year. What happens if you find yourself in a situation where you're unable to afford the tax payments? Now, if you found yourself in this situation, I would say one of the best things you could do is to call HMRC and arrange what is known as a time to pay arrangement, okay? This gives you an extended time period of say between 9 months and 12 months over which you can spread those payments, okay, and makes it a little bit more affordable for those who are unable to pay that tax liability upfront, okay? So this is definitely an option, but ideally what you really want to do, as I mentioned before, is to ensure that you are working alongside your accountant to budget for your approximate amount of tax liability on a monthly basis, okay? So ideally you should be budgeting a proportion of your monthly income that will go towards paying your tax liability at the end of the accounting year. Let's talk about some of the ways you could use in order to reduce your tax bill, because this is going to be very important, particularly if you found yourself that you're in a position where your profits are increasing, because as your profits are increasing, then naturally you are putting yourself in a position where your tax bill is also likely to increase accordingly. So the first way that you could think about actually using to reduce your tax bill is to think about taking a salary, okay? So if you're a director of that company, one of the ways you could use to reduce your tax bill might be to actually take a salary for yourself out of that company. Of course, a salary in itself does have its own sort of tax considerations around it, but at least in that sense, if you're paying yourself a salary at the right level, then you will be able to find the sweet spot that will allow you actually minimize your tax liability overall. A second route you could take to minimize your tax bill is to actually think about investing some of this money into a pension pot, okay? Because pensions are largely tax deductible, okay? So this is going to be a very tax efficient way to help you not only invest for the future, but to also minimize on your tax bill. Now, a third way that you could think about actually utilizing to help you reduce your tax bill is to ensure that you are claiming as many tax allowable expenses as possible, okay? Provided that they are actually in relation to your business. It's going to be very important that you are categorizing your expenses well and also working with an accountant who can guide you on what are some of the best tax allowable expenses that are claimable for your business. And if you're really stuck and you are unsure of what some of those expenses might be, or some generic ones to start to think about, then in this video here, I have shared some core examples of what most business owners might be able to use as tax allowable expenses to help them minimize their tax bill. Click here to watch it now.